Hey traders, Nick here doing some homework after hours. So today, in the chat room during the earnings release of a couple companies, a concept came out. How do I lock profits in options after hours when I see something that may not last through the morning? Let me explain. Let me use GME, which is the craziest ticker of them all, right? GameStop, as the perfect example. So the concept is they were reporting earnings after the market closes, and it's really a binary event. We don't know if it's going to go up or down. We had the thesis. Somebody took a bet on calls, let's say. So they bought. Let's use 122 as an example. The 122 call. Now, if you're new to options, buy the 122 call. I pay a premium. Whatever that premium is, it's money out of my pocket. That gives me the right to buy the shares at 122 for a period of time. So let's assume that they did it for this week or next week. It doesn't really matter. But they bought the right to own the shares at 122 if they choose to. They're in control. So that right is open for as long as the contract is valid. So if they chose next week's expirations, then they have about 10 days to decide whether they want to buy shares at 122 or not. So you're in complete control. And then this happens after hours. The stock soars to 132. And you're thinking to yourself, sweet, I'm going to book my profits. It's up 8%. You can't do that after hours with the options. So you're stuck hoping the next day it opens the same place. Well, look what happened. Drop. Now it may still rally tomorrow. But how can that person lock their profits somewhere up here? So you can't sell this after hours. So you have to replace it with something other than that. So there is a trick to do. I encourage you to look into it before you jump in. Anytime you're selling short a stock, especially GME, you better make sure you know what you're doing. So the idea is to short the stock outright after hours when it spikes. So what happens? I short it after hours. And so what's the position then? I'm still holding the right to buy it here. So I'm not creating risk. All I'm saying is get me out at 130 or 131 or 132. Let's use 132 for you. And did it get to 132? It did. So let's say we nailed the top at 132. Nice, easy math. So, yes, I take the easy route when I need to explain something. So, in essence, I paid a little bit, let's say $1, also making up the number. So, $100 per contract for that right. It's clearly not that, it's more. And then, boom, stock rallied. I sell short the stock. What does that mean? I sell stock I don't own. That's how people short stocks. They sell a stock they don't own. I open a trade saying, sell 100 shares of GME. Now, I have to own at least one call in order to do that. So if I own 10 calls, I can do 10 times 100. So I can short 1,000 shares. Every call I own covers me for 100 shares, not more. So I sell short GME. Now what happens? So now I'm short GME. And the risk is, what if GME the next day does this? You're saying, oh my God, I'm losing money. No, I have the right to buy it at 122. So in essence, by doing that, I'm capping my profits at 132. Above 132, I put in an order to sell it. So if in the morning the price is up here, I'm out at 132. I stopped my profits at 132 because I would exercise this. That would bring the shares in at 122, and I already sold it. So when I exercise this, the position of being short that I initiated tonight, tomorrow morning will be gone. Because I wake up, broker, I own the call, can you exercise me? That is if price is up here. Boom, no harm done. The worst case scenario was me profiting $9. Why not 10? Because I paid $1 to be in it. Now, if I paid $3, then I profit $7. You see what I mean? So I own the right to be long at 122. Therefore, selling short the stock at 132 guarantees me the win to 132. Above that, I'm out. Below that, I can still make some money. Let me explain what happens. So let's say tomorrow it doesn't do that, and it did this, and it opens here. Let's leave that up there. Let's say tomorrow morning it opens here somewhere. So what happened? I still own that call. I was short at 132, and I woke up, I can cover my short at 124. What does that mean? So when I short a stock, I literally sell the stock I don't own. I take the money, 132 times the number of shares, and put it in my bank because I sold it. Now the shares dropped. I can cover that short by buying it back at 124. So I made $7. I just profited $7 overnight. And I still own that call, which is still worth money, which is still an asset in my pocket. So I have things to do tomorrow. I could exercise my call, but I don't think that'll bring me profits. I think if this was the case, I would cover my short, which is $7 or so, and still own a call where I can decide to do whatever with it in the next couple of days. So it all depends if it expires this week or next week or what, right? So that is basically locking my profits. Otherwise, if I didn't do this after hours, then it opens here and I wasted my money. Because if it just rallied, however it's rallying right now, I can't do math, 1% with GME's implied volatility, I probably lost money. When it opens tomorrow, yeah, it's up 1%, but the premiums I bought are probably inflated. And tomorrow they will not be inflated because the event is gone. So in essence, I gamed the system after hours by using equities in order to book profits in options. This is pretty tricky stuff. So think about it, ask questions, look into it. Again, I will repeat the concept. I got long GME, like if somebody, I didn't. I'm repeating somebody else's comment. I got long GME at 122 as a guess on the earnings. It closed. It soared after hours. I wanted to book my profits. I can't. I own calls. Those are not tradable after hours on stocks. So what do? The next best thing is to sell shares equivalent to the number of calls I have or less. Sell shares. And what does that mean or less? If I own one call, I can do up to 100 shares, but I can do just 50. So if I do 100 shares and I say sell them, they'll give me 132 times 100 goes into my account, but because I sold them, but I don't own them. But I didn't create risk because I own the right to buy them at 122 and I sold them at 132. So worst case scenario, I made $10 minus the cost of the call. All right. And then if it drops like it did, tomorrow morning it opens here, I can cover my short, make this much money, and still own the asset I started with. See what I mean? So that's the scenario. These are little tricks that somebody can do with the options after hours indirectly. All right, again, I caution anybody to jump into the deep end of the pool before doing the basics. So practice with fake money, paper trading. GME is not one to learn with. It does not forgive, especially shorts, right? Melvin Capital, $8 billion hedge funds folded because of this one stock. So be careful with that.